Today, we're unpacking the August 2025 Employment Situation Report, which just came out a few days ago from the U.S. Bureau of Labor Statistics. Now, this report, it's always a crucial economic barometer, right? It gives us vital insights into the health of the U.S. labor market, and its implications are already sparking some pretty intense discussion. So the central question we're grappling with is this. Do these latest figures paint a picture of a robust, a resilient economy, one that's, thriving under current leadership? Or do they actually signal a sharp slowdown, maybe a weakening labor market, and some concerning economic trends that, might be directly attributed to specific policy choices?
Exactly.
Our discussion today, it draws from official government statements, folks like Secretary Chavez-Dramer at Labor, and also congressional analyses, say, from Representative Don Beyer, plus broader news coverage from places like Global News. I'll be arguing that this report, if you look at it holistically, it really underscores a remarkably positive economic performance. I'm talking strong wage growth, underlying resilience, despite some challenges, of course.
And I'll be taking the opposing view. I think a closer, more critical look at this August report paints a far more concerning picture than maybe the headline numbers suggest. While, sure, I understand wanting to highlight the bright spots, the report taken as a whole delivers what I'd really call, frankly, woeful news. It confirms the economy is getting scary, as Representative Beyer put it, for American working families.
Okay.
I mean, just consider the unemployment rate. It rose to 4.3%. Now, that's not just a small tick up. It's the highest it's been since the pandemic. A significant jump, worse than expected, really the highest rate since 2021. For many, this signals a real softening in the labor market, kind of moving away from what we thought of as full employment. And then there's the job growth number itself. The economy added a scant 22,000 jobs in August. I mean, put that in perspective, it's way below the roughly 80,000 economists were expecting. It indicates a clear lack of momentum. That's hardly a sign of strength or vitality.
Okay, but 1 month.
Well, and it compounds this. We saw significant downward revisions for June and July payrolls. A combined 21,000 jobs cut from those previous estimates. And this is critical. June's final figure actually showed a loss of 13,000 jobs. Now that marks the first monthly job loss since December 2020. That's undeniably a troubling indicator, right?
Okay.
So when you look at the average, job growth has just slowed sharply. It's averaging just 27,000 jobs added per month over the past 4 months. Compare that to the 186,000 jobs per month we saw throughout 2024. This isn't some gentle slowdown. It's a really pronounced deceleration. And that has real consequences, pointing to a weakening job market.
Okay. I see why you'd focus on those specific numbers, the revisions. And yeah, they certainly warrant attention. But I do believe if we step back, look at the broader economic landscape, the August jobs report remains fundamentally a positive indicator. It reflects a strong and resilient U.S. economy. I mean, think about the context. We just came off Labor Day weekend. Gas prices hit their lowest point in 5 years. That's tangible relief for families.
Sure, gas prices are one thing.
And crucially, we are seeing strong, consistent hourly wage growth. It's up nearly 4% year over year. That's significant because it means paychecks are growing faster than inflation, which, by the way, has actually been lower here in the U.S. compared to global trends. And I attribute a lot of this to, the America First leadership, this strategic approach focusing on bolstering our domestic economic strength. Furthermore, remember the second quarter GDP figures? They smashed many economists' expectations, showing robust growth, resilience, maybe something the August jobs report in isolation doesn't fully capture. And it's also vital to note, all job growth this year, it's been concentrated in the private sector and among native-born Americans. That suggests a targeted, internally driven strengthening. My primary concern actually isn't the economy's underlying health so much as external impediments. Like Secretary Chavez-Dramer said, the Federal Reserve might be failing American workers by, dragging its feet, refusing to lower rates. I've heard this frustration echoed on the Secretary's listening tour from entrepreneurs, business owners. They feel the economy could be even stronger if the Fed acted.
That's an interesting point about the Fed.
But I just find it hard to accept the overall picture as positive, given, well, the depth of the slowdown and what seems like the clear impact of specific policy choices. You highlight wage growth, sure, but the report also indicates inflation is actually heating up. Prices and unemployment are both rising, so even if some wages are up, the purchasing power for many is still under pressure.
But the rate of wage growth is outpacing inflation.
For some, perhaps. But we can't ignore that the economy added a mere 22,000 jobs in August, far below expectations. And those revisions for June and July? Look, they aren't just standard practice refinements when they cut 21,000 jobs combined, and critically, turned June into an actual loss of 13,000 jobs. That's the first negative month since December 2020. That's a significant marker of a downturn, not just some statistical adjustment. It changes the story. The sharp slowdown in job growth, it's undeniable. Averaging just 27,000 jobs a month recently compared to 186,000 last year, that's a clear, concerning loss of momentum. You can't just dismiss that lightly.
Okay, while those 22,000 jobs, yes, it's a lower number than we'd ideally prefer, it's crucial to remember where this growth is concentrated. It's here, among native-born Americans within the private sector. That, to me, is a positive sign of internal strengthening, not some universal slowdown. It shows domestic policies are fostering job creation for our own workforce. That's a key objective of the America First strategy. And when it comes to revisions, yes, they happen. They're standard, they're necessary as more complete data comes in. The BLS refines its estimates. It doesn't invalidate underlying trends, it just gives a more accurate, sometimes delayed picture. We need to focus on the continued expansion, even if the pace fluctuates, in these crucial, domestically focused sectors.
Month like June, from positive growth to an actual loss of 13,000 jobs. That's not refinement. It fundamentally alters the economic narrative. It signifies a clear shift. And frankly, claiming targeted domestic strengthening while job growth averages only 27,000 jobs over 4 months compared to 186,000 last year, it's difficult to reconcile that with a truly healthy economy. That sharp slowdown, as Representative Beyer correctly pointed out, it confirms a weakening U.S. job market. The momentum has clearly evaporated.
Okay, I see your point on the magnitude of the June revision.
And this brings us directly to what I see as a key driver of this weakness, the role of tariffs. Representative Beyer, Olu Sonola at Fitch Ratings, they've both argued that Trump's policies, specifically these tariffs, are a key driver of the economic weakness. We're seeing continued declines in sectors that were supposed to be bolstered by these policies. Manufacturing shed 12,000 jobs in August. That's the 4th straight month of cuts. Construction cut 7,000 jobs. These are industries where a boom was promised, yet they're contracting.
But correlation isn't causation.
Well, the imposition of tariffs creates significant uncertainty. It increases production costs, disrupts supply chains, and makes managers reluctant to hire or invest. This directly contradicts the promise of a manufacturing resurgence. It signals a tangible negative impact, stifling the very growth they were meant to foster.
That's a compelling argument, and I understand the concern about those specific sectoral shifts. However, I would frame the impact of tariffs and our broader America First approach, differently. These aren't just ad hoc taxes. They're intended as strategic tools, right? To strengthen the domestic economy long-term, level the playing field. Any perceived negative effects, maybe they're overstated, or temporary adjustments needed for long-term benefit, or perhaps even misattributed. Maybe it's other market dynamics at play. I mean, some industries might be retooling, reshoring. That involves short-term disruption for long-term strategic advantage, building more resilient domestic supply chains. Our policies, like the Working Families Tax Cut, they're designed to boost consumer spending, create a more robust, self-sufficient economy. And the overall picture, again, private sector job growth for native-born Americans this year, it suggests the broader strategy is having a positive impact, even if there are uneven effects sector by sector.
It's a hard case to make when those key sectors are bleeding jobs month after month.
Let's also revisit inflation, wages, and the Fed, because these are absolutely critical. I reiterate, consistent hourly wage growth, up nearly 4% year over year. Coupled with lower inflation here compared to globally, that paints a picture of a healthy economy where workers see real gains. My concern remains squarely with the Federal Reserve. Their reluctance to lower rates is, I believe, actively hindering expansion. Secretary Chavez-Dramer's tour hears this constantly. Entrepreneurs feel constrained by high rates. And look, wage growth at 3.7% year over year, it's nearing the Fed's own 3.5% target for 2% inflation. That's the level they consider consistent with healthy, non-inflationary growth. So the rationale for keeping rates high seems, well, increasingly tenuous, maybe even counterproductive.
I appreciate the focus on wage growth, but again, the report also shows inflation heating up. Prices and unemployment are both rising. So while some see wage increases, the overall cost of living climbs, eroding those gains for many families. And the Fed's cautious stance isn't just dragging its feet. It's arguably a necessary response to the lingering effects of, 11 rate hikes from 22-23, plus the ongoing economic uncertainty from trade wars. As Olu Sonola at Fitch explicitly stated, it's hard to argue that tariff uncertainty isn't a key driver of this weakness.
So you think the tariffs are the main problem, not the Fed?
I think the tariffs are creating uncertainty that complicates the Fed's job immensely. And look, the weak August numbers, they make a Fed rate cut all but certain at the September meeting. That implicitly supports the idea that intervention is desperately needed to stop a deeper downturn. And we can't ignore the, frankly, unusual political pressure on Fed Chair Powell or the attempts to fire Governor Cook. Those actions undermine confidence in the Fed's independence, don't they?
Well, the president is advocating for workers.
Beyond the immediate numbers, we have to consider broader economic health and, yes, data integrity. The signs of distress go beyond one report. Challenger, Gray, and Christmas, they reported over 892,000 job cuts announced this year through August. That's already more than all of 2024. Unemployment applications are rising, highest since June. And really troublingly, the Black unemployment rate jumped to 7.5%, even higher for Black women. That's a deeply worrying sign, often a canary in the coal mine for the broader economy. Now, data integrity. President Trump fired the BLS commissioner after weak July numbers, claimed manipulation, nominated a partisan ideologue. Yet the August report, overseen by a career official, completely supported the previous trends, showing a weakening market. While experts trust the BLS procedures, these actions, plus known issues like falling survey response rates, you can't just brush that aside when talking about confidence in the data.
Look, I'm not convinced by that line of reasoning. It seems to conflate distinct issues. Yes, announced job cuts, rising applications. These are dynamic parts of a huge economy. Churn happens. These points don't necessarily negate the overall positive trends in private growth and wages. Regarding the data, yes, it's complex, subject to revision. That is standard practice due to late submissions, as Global News noted. Survey response rates are a global challenge statisticians are tackling. But the overwhelming confidence from nonpartisan economists and BLS procedures assures us the data itself is safe from political interference. Despite complexities, the overall picture, strong GDP, wage growth, domestic private sector jobs, remains positive. It supports Secretary Chavez-Dramer's view. We need to see the whole forest, not just focus on a few struggling trees.
I think those struggling trees might be indicating a problem with the forest's health.
So in sum, while we've explored various facets here and engaged in some areas of continued discussion, my position stands. The August report, viewed comprehensively, signals a resilient U.S. economy. Strong hourly wage growth, robust private sector activity, these are clear indicators of health. And I firmly believe there's even greater potential that could be unleashed if the Fed adjusted its policy and stopped, impeding growth.
And I come at it differently. The data, to me, undeniably points to a significant slowdown. Rising unemployment, especially for Black Americans. Declines in key sectors like manufacturing. These trends, combined with rising inflation, aren't isolated incidents. They seem largely attributable to current policy impacts, especially tariffs. It represents a worrying trajectory for American working families. The economic headwinds feel substantial.
Ultimately, the nuanced data within this August jobs report, it clearly allows for multiple credible interpretations about where the economy is heading and how effective current policies are.
Indeed. And examining these different perspectives, it's crucial, isn't it, for gaining a fuller understanding of these complex economic realities and what they actually mean for people.
Absolutely. And further exploration of the underlying data, its implications, that will continue to be essential as we move forward.